saw 27. I don't know what's going on with Webull. Let me read. But for me, what I'm doing is I am picking up. I got a good amount of Dogecoin in multiple accounts. So right now it's just a wait and see for me. But I kind of like the catalyst behind Dogecoin. So if y'all are just tuning in, again, so I noticed that it's trending a lot on Twitter. People are posting about it on Instagram. I'm pretty sure, like you're seeing right now, for those who are watching me on Facebook, if you're watching me on YouTube, you're probably seeing a ton of videos being released about those.
I mean, people, they have the Midas touch. This is a 24-page complaint by the state of Massachusetts. Now, we all probably think, wait a second, aren't we a federally followed, federally, authorized? We have the SEC. I mean, I always find these as being, are you kidding me? I mean, the state of Massachusetts, aren't you a member? Aren't you like the 49 other guys? But they can cause a lot of problems if you're about to come public. If you come public, you don't want the state of Massachusetts suing you.
Right. Speaking of regulators, Jim, there's these comments out of David Einhorn talking about what he called, I think, quasi-anarchy ruling the markets, talking about some very small cap names. And then this quote about Chamath and Elon: if regulators wanted Elon to stop manipulating, they should have done so with more than a light slap on the wrist when they accused him of manipulating Tesla shares in 2018. Still, though, Jim, some believe that with Gensler now confirmed this week that things are going to change.
Gensler's very sophisticated, and he's not I would say he's not a backslapper. He's not happy-go-lucky. I think he's going to look at the mortgage. I think he's going to look at this Massachusetts. This thing, by the way, is not an idle complaint. I mean, Massachusetts is literally saying that regarding options trading, they're not doing the right thing. When you see something like that, when you see violating company policy, that is what Gensler excels in. I mean, I think he may look at this thing and just say, this thing does not have the controls.
Right.
Well, really that belong at any securities firm, David.
No, well, they learned the hard way, right? I mean, it was an unexpected, to say the least, event what happened in GameStop. But I think there's little doubt, and certainly having spoken to many people around it since then, that if they didn't raise that $3 billion, they were done. They were done.
That was a bad weekend for them.
Yeah, but they lived to tell.
Yeah,
they lived,
weekend.
And one would expect that their risk management and that they realize what they really are, which is they're a broker dealer, right? They're not. That's what they are.
Yes. And it was by the way, it was the AMC that really broke them. Not GameStop.
Not GameStop. Yeah.
AMC.
Right.
No, it's AMC. You know what's amazing, David? I have a friend who got the call that Saturday. Mm-hmm. It was from Vlad. Vlad Tenem, of course, not Vlad Lenin. And Vlad said, "Look, I need $3 billion." And my friend said, "Well, can I see a P&L?" And apparently, Vlad, we don't know for sure, but it said, "In P&L, I just need the $3 billion." Now, David, even in this day and age, I think $3 billion is a lot of money to ask for without having a P&L.
It is a lot. I agree. It is.
Right? Yes. I mean, they could. I'm sure they could have gotten together P&L.
It's going to be very
But they
interesting.
needed the $3 billion, David, pronto.
Yeah, they needed it immediately, if not sooner. Yes.
Yeah. It's kind of like, well, I mean, can we talk about it later? Send the $3 billion in, and then we'll have a frank discussion.
How do you come public when you got Massachusetts now on you like this? I don't know.
Well, that's what I'm thinking. I mean, but it's a commonwealth. Maybe you just say the states are okay. It's a commonwealth. I guess PA is a commonwealth, and Virginia's a commonwealth. So you go with 47 others? I don't know, David.
Yeah.
I tried to get Vlad on the show last night. I can get, hey, listen, I can get Jagdeep on, but I can't get Vlad.
Don't know what's wrong
These
with
are all the first name people of this new generation. You got Jamie, you got Jagdeep, and you got Vlad. Who else do you have, David?
Well, you got Elon, of course.
Right?
Elon, yeah.
Well, who else? Who is like Cher of this era? Give me a Cher.
Give you a share. How about?
Give me a Cher.
How about Mr. Kitty? How about him? Little Kitty, Mr. What was his name? I forget. That guy. Roaring Kitty.
David,
Thank you.
I come to you with diamond hands and YOLO, and you give me nothing.
I got nothing for you this morning. I got a lot going on.
Carl,
can I tell you?
He doesn't understand pop culture or stock pop culture.
Sad.
I mean, there's got to be another guy besides James in banking, right?
It's really sad.
Dave doesn't work. DJ Saul. DJ Saul.
It's been almost 10 years, Jim.
David, I need $3 billion this weekend.
Somewhere.
I need $3 billion this weekend.
All right. I'll give it to you. I'll wire it over. I'll wire it.
I promise to give you P&L later on. Okay. I'll give you the instructions.
Guys, quick break. We're back in a moment. On this Friday, what a week it has been between Q1 earnings, the J&J pause, the macro data, Coinbase and crypto, and obviously the record highs and futures looking to build on it this morning. Dow looks to open up 100. We're going to get that opening bell in about 5 minutes. We haven't talked a whole lot of vaccine or pharma yet. That brings us to Cramer's Mad Dash.
You know something, Carl? A stock that's been left behind that is almost quizzical is Pfizer. Now, here's a company that obviously has the cure, so to speak, for the hour at least, and that's what I want to go for, because what they've got is a vaccine that is considered to be incredibly effective. But you know what? It looks like, because of all these variants, we're going to need a booster. Now, Pfizer makes a tremendous amount of money off the vaccine. I mean, maybe people feel it's free. It's not. And that could really help them bridge what is regarded as being a very difficult patent cliff that they have in 2025 if we have to get a booster every year. Pfizer is very disliked. I mean, the price-to-earnings multiple of Pfizer is one of the lowest in the market. It sells at about 10 times next year if we get this additional booster, and it yields 4%. Carl, to me, the amount of money it's making could allow it to bridge what's the patent cliff, because they'll be able to buy somebody. They've been an acquisitive company. So I just can't believe that this thing doesn't trade higher. It's been a dog.
It's a good company. But it's amazing scientifically and logistically what they've collectively been able to do, Jim. B of A this morning points out we're going to do 1 billion jabs by April 23rd. 1 billion jabs around the world for something that a year ago seemed unthinkable. And by the way, this journal story this morning, that says that J&J privately reached out to both Pfizer and Moderna and said, hey, look into clocks and maybe we can speak with one voice, and the other two declined.
Yeah, gave him the Heisman. I have to tell you that Dr. Bourla, who is truly a scientist and an intellectual, was able to rustle up what I think is probably the biggest freezer farm in the world up there in Kalamazoo. Everything that they've done has been done right. They've been done independent. And I think a lot of people in this country recognize that maybe they owe their lives to Pfizer, but they don't want to own the stock. And I find that curious. I think the stock could represent great value.
And it's funny, Jim. I think I saw you yesterday tweeting, starting to question the decision making behind pulling or pausing, I should say, the J&J vaccine.
Oh, yeah. I mean, David, this is such a small. Well, one person died. We never want that. But David, I think that they've made it so that some states are already full and people don't want to take it because they think it's dangerous. The CDC, David, I think is kind of acting in a rookie fashion. The NIH seems to have lost touch with America. These people seem to be not understand, David, that there's a resistance to taking the vaccine to begin with. And they just make it so that you're more scared. What about a simple label which just says, look, if you have X, go back to your doctor? But David, this is this is more dangerous than the flu shot that you go to Walgreens and take. That's not right, David. Less dangerous, and now they've made us feel like it's more dangerous. And then this J&J can't get these other guys to go with them. Now you really feel like, wait a second, you got this Baltimore facility, the Emerging Bio, you got this NIH and CDC really making you feel like maybe this vaccine's dangerous. You got New Hampshire saying no more masks. There's no social distancing anymore. People are on top of each other again, and it's not cured. We're getting 70,000 people getting this every day and 1,000 people dying. What is going on, David?
Well, I'm not the right person to ask, as you know. It doesn't.
Well, you're my partner here.
I am your partner. Don't you ever worry about that or question that. No matter how mean you might be to me, I will still be there, and I'll give you your $3 billion this weekend, as I promised. But in terms of the variance, Jim, I mean, in behaviors, you're right. A lot of people don't have full answers. There is a belief, of course, in Michigan we've talked about, because that, unfortunately, right now is the center of the worst outbreak amongst the states in the country. Right. And hospitalization rates are going higher there, and deaths are, unfortunately, going higher as well. But the hope is the vaccines will overwhelm it all. And they likely will, Carl, given the rate at which vaccinations are taking place. But there is still a need to potentially be somewhat cautious in certain interactions if you're not vaccinated. Three of us, or at least I know Jim and I, are fully vaccinated. Jim, you and I are going to be back on this set together on Monday.
Are we?
Yes.
Can we do a mad dash with clasped hands?
Yes. Yes, we can.
Okay. Clasped hands. Okay.
Yes.
It's an I Spy joke from a long time ago, about 50 years ago.
Yeah,
look, I got to tell you that the restaurants are getting open. You have to be you have to put half the people in that you could. Otherwise, you basically have to do contact tracing. Now, I love you, David, but I'm not going to contact trace you. No, I don't have that in me.
Okay, that's okay. But you know what, Carl, testing is going to be with us for a very long time. And then when it's funny, when we have this conversation, I get back to thinking about reopening and about people coming back to offices and when that's going to fully happen and how businesses are going to be dealing with it and when they're going to potentially say, well, we'd really like you to get a vaccine, but can we require you to? No, but when will you come back? We'd like you back, and go from encouraging to perhaps being more disciplinary in approach. These are all key questions a lot of people who run organizations are grappling with right now. As we move forward with fully reopening.
Are you aware of the Citi program, David? The Citigroup program?
No, tell me.
Where they're making, people have to get tested at Citi. This is done in conjunction with Dr. Minna from Harvard. And basically, Monday, Wednesday, and Friday, before you come to the office, do a little test. I'm getting the Abbott test this week. I'm going to start taking Abbott every day, David, because if I'm going to be that close to you, I got to protect myself from you, and vice versa.
Well, when you say something like that,
I promise to test every day.
Really? I mean, why would you do that? You're fully vaccinated. The chances that you could actually catch anything are extraordinarily low.
There are 5,800 people who have caught something.
0.008%.
5,800 people.
Yeah.
True.
Okay, well, so why would you do that?
I don't know.
All right.
So it's a good idea.
Is that a rational approach? Is that really based on the data? Is that how you would approach risk in other areas if you knew the actual data?
No, but this one, you still have to quarantine periodically. Like, David, where the hell am I right now? I mean, everybody but can you get the dog over here? Where the hell is Marley? I mean, this place. I mean, look, I'm like at home. The doorbell rings. The dog barks. This is amateur hour. It's a Ted Mack amateur hour. Carl, I can't stand it. I want to go back to the set. I mean, yesterday someone the kid ordered Chinese food in the middle of Mad Money. I mean, this is nuts.
It's a weird collision. Everybody who's worked from home understands the weird collision between your work and your family when you're working at home. But by the way, guys, although there's a lot of optimism about vaccination, we are nearing the all-time high globally for cases. Canada, of course, Ontario's not in good shape. India is still a mess. David, I see right now the head of the Tokyo Olympics is having to once again reassure the world that the games won't be canceled because of the surge in cases in Japan. And by the way, we do have an upgrade of our parent Comcast, which relies heavily on the distribution of those games.
Yes, it does. Yes, it does. And obviously parts of Comcast business in terms of theme parks, for example, also impacted, and movies, as we all know as well. You know, Jim, when we talk about other parts of the world, because we are doing quite well in vaccine distribution in this country, when we talk about the EU, we look at those Chinese growth numbers. Okay, they've been open for a long time. They're back to normal quite some time back. But what about worldwide growth and how you sort of try and interpret that and infuse that into your overall view of the market at this point, given there's a lot of laggards out there when it comes to really combating the virus with vaccines right now?
Well, look, I know that I personally thought that J&J would be producing hundreds of millions this year. I think Pfizer's capable of doing that, but there's 7 billion people on the planet, and I think that the best doctors would tell you, given the fact that we have no immunity against this, that unless we get everybody, then we're in trouble. Now, what's interesting is Israel's about 60%. And they think that they've wiped it out. So we don't necessarily have to get to 100%, but we still need, that would mean about 5 billion. David, there'll be countries that are off limits for years if they don't get this solved. Right? I mean, just off limits. I mean, remember, Italy's not solved. My daughter's in Spain. She hasn't been able to leave Madrid for 2 years. She teaches English there. I mean, that's ridiculous. Well, it's not ridiculous, but Spain doesn't have it under control. Italy, not under control. These are developed countries, David.
Yeah, well, Carl, we know the EU, while it did a fairly good job in terms of containing the virus with actions to do so, it has not done a particularly good job when it comes to distributing vaccines yet, and that continues to be a key issue.
Yeah. You know, guys, I don't know if you've seen this yet. It's kind of a long report, 90 pages out of Katie Huberty this morning, guys. But it's basically about the new workplace and her argument that work from home is going to last longer than we think. And there are implications for technology on that, Jim. In her words, longer and higher, because the idea that we're just going to go right back to where we were in terms of office work is just not in the cards, she says.
Look, the banks want it to happen. I think that they may want it to happen, but they'll often tell you, look, there are people who won't come back. Now, one of the things that's happened in this era that's different from when I worked on Wall Street is there's actually freedom of action. There are people who are saying to the top bosses, look, I can't come back. I have a comorbidity, or I can't come back. I'm worried about some immune problems I have. And none of these companies is going to take on the risk of telling someone with that they can't come back. So, and then there's also this hybrid model where people are saying, listen, Tuesdays and Fridays, I don't go into the office. Now, Carl, what's amazing to me is that the bosses are not saying, well, you're fired. It's almost as if they're afraid of discrimination suits. They're afraid of suits that basically say these are protected class people. So it is going to be a new workforce that basically says, hey, today's not my day. And there's going to be a substantial change in the way office work is done and how the cubicles work and the offices work. I think it's really great for any company that does, where you ran a few offices at a given time, including some firms that we thought were never going to make it. So I don't know, Carl. I have never seen CEOs have less power in my life. They can't get people to come to the office. What a basic thing that is gone. No, I'm not coming in today. Well, are you sick? I'm not coming in today. I mean, David, I don't know.
Same, Jim. Same.
Carl,
Hear it all the time. I'm hearing it constantly.
Right?
And I mean, you're nailing it. It's exactly the same conversation. Not sure what we can do, how we approach it. Maybe by September we start to make it clear, well, maybe our culture and your view of our culture are two different things, and therefore we should part ways. But they're not there yet. Carl?
No.
Yeah, and by the way, guys, add Georgetown to the list of the colleges that are going to be mandating vaccines for students in the fall. We do got record highs on the S&P. Again, record high Dow. The VIX closer to 16 this morning than 17. Let's get to Bob Pisani. Hey, Bob.
Hello, Carl. Happy Friday. Great week overall. We're up 1% on the S&P. All 11 sectors started on the upside, 2-to-1 advancing to declining stocks. This has been a really strong week every single day. I want to point out, tech's flattish today, but it's been fine this week. It's with the markets up about 1%, but it's defensive stuff that has lagged before that sort of caught up this week. So healthcare, for example, and REITs have been doing well. Healthcare, REITs, utilities also up about 2% so far this week. So the defensive are doing well. Banks up fractionally today, but actually banks have lagged this week. And there's two reasons that the banks have lagged this week. One is they tend to drop a little bit going into earnings season and immediately after that. And the second reason is, other than the core numbers have been fairly tepid. The stuff the people who follow the economy care about. Trading numbers have been fantastic for the big money center banks. But now you're getting into the big regional banks where the economy is more important overall to what they're doing. So look at PNC today. Had a big provision release. They had a huge beat on earnings, but it was a provisions release. There was some other things that was in there that was important for them. But look what I call the economy stuff. Average loan balance was down 2%. Net interest income was down 3%. Net interest income and margins were lower because there were fewer loans out there and there were lower securities yields overall. So that's the stuff people care about. Net interest income and loans. They were all kind of on the tepid side. All the banks basically reported this. Yes, trading activity was amazing for many of the big money center banks. But look at the response to the market. We had these blowout earnings from these companies this week, and this is what they've done this week. Pretty tepid response given the amazing numbers. That's because the street's looking through it and saying, well, how's the actual real economy numbers doing? It's fair, but not amazing overall. Meantime, if you look at what's really going on in terms of like sectors that are lagging, some of the thematic tech stuff has been lagging recently as the markets move forward. And boy, these electric vehicle stocks, I mean, these stocks were just darlings of the media 5-6 months ago. And most of them are down 20, 25, 30% this month, this week. And well off of their highs. Some of them are 50% off their highs. I mean, Plug Power was just a tremendous darling towards the end of last year. All of these companies, of course, have tremendous potential in the future. None of them are making any money right now. Of course, we don't see on the list here is Tesla. Tesla's had a good week overall, Carl, up. But these stocks have had a stunning fall from grace just in the last couple of months. Carl, back to you.
All right, Bob, thanks. Bob Pisani. Obviously, you got to keep your eye on the 10-year, which had an interesting day yesterday. Good morning, Rick.
Good morning, Carl. There's so many ways to look at yesterday. I like to keep things simple. Consider yesterday a technical violation of an important level. Now, look at an intraday chart of 10s. What you'll see is, of course, at 8:30 Eastern, we went zoom, zoom, zoom. And that's because we had pretty good data. But you might be saying, well, yesterday was the data really, that bad to make interest rates go down? And yeah, maybe claims were a bit disappointing, but I say the answer is no. It was technical. Now, as you look at a 2-day, I can give you virtual reasons why it was technical. First of all, look at yesterday's low. 1.52%. And where did the violation start from? 160. Now, if you open the chart up to the 24th of February, here's what's interesting. I can't show you an intraday that far back, okay? It's too many days back. But I'll tell you, on the 25th, That spike there to the right, that little spike, that close is 152, where we held yesterday. You know what the intraday high was that day we closed at 152? Yes, that was the day we had the 161 spike. Comes down, settles at 152. That was the low yesterday. That was the violation. Technical. Now look at the knob. The knob's starting to firm up a bit. It gave us early warning when it started to move lower and flatten that maybe the long-dated treasuries are running out of virtual horsepower to the upside and yield downside in price. That might be abating. We might be coming into support levels. And finally, the euro versus dollar. Why am I showing this? Because the dollar index has been under pressure. It's down pretty substantially for the week, probably because the euro dollar at 57% of that is up nicely, closing at the best levels in well over a month. Carl, Jim, David, back to you.
All right, Rick, we'll talk to you soon. Rick Santelli. Later this morning, as we wrap up this inaugural week of Tech Check, do not miss an interview with Airbnb's Brian Chesky at 11 a.m. Eastern Time. Shares of the company, by the way, up about 19% so far this year. More Squawk on the Street continues in a minute.
Well, guys, at this time of the week, I'd like to go over the landscape for SPACs, which, of course, we've spent so much time talking about this year, given their importance in the capital markets, the importance they've had to any number of investment banking firms. We've, of course, seen numbers from Morgan Stanley and Goldman Sachs. You know, Goldman says only 15% or so of ECM, if I recall. But they have been an important component, but they have been slowing down dramatically in terms of issuance. And this week is less than last week. Last week was less than the week prior to that. You can take a look. Still out there looking for deals, 431 filed, not yet public, 245, and there's the proceeds raised. But what about this week? Well, There are only two. There are only two SPAC IPOs and 3 companies that filed, Jim. So, it really is slowing down dramatically. And I want to talk about the IPO market itself because it's been an interesting week on that. But I will say one thing, Jim. We talk so often about the SEC, and I would point out that today, 2 SPACs that filed to go that are going public both don't have warrants. Warrants, of course, have been a key component of all of these deals, typically struck at $11.50. Remember, the shares sold usually at 10. But the SEC, has created some uncertainty in terms of accounting for those and the treatment of SPAC warrants. And so you've got a halt in a lot of new registrations, and you've recently seen a few of these without warrants. Jim, not just SPACs, but it was a weird week for IPOs. We focused so much on Coinbase. Yesterday, not good performance from those other companies that came public. And so, we see this sometimes. We don't know if it augurs for difficulty perhaps in the future for, broadly speaking, actual IPOs as opposed to just SPAC IPOs, but worth pointing out as well.
Well, look, the market's exhausted from these. Some of them have been breaking down systematically every day, particularly anything that's EV. And I think Gensler is someone who is a very sophisticated regulator who will say, I don't understand how you can make these projections from Romeo Power and be wrong 6 months later. We're going to eliminate projections. Or he may just say entirely, you know what, let's put a pause on this thing. I want to study it. The previous administration was kind of I told you it was a Cole Porter song, was anything goes. And that's over. Gensler is too much of a regulator. By the way, Clayton was just a terrific guy. I mean, really nice guy. But you know what, David? That historically has not been criterion for tough SEC commissioners.
No. Nice guy's not necessarily in the job description. That's right. And and to your point, it's not just sort of some unusual structures or warrants, but it is also, we've talked about it a lot, the projections that are made, because they can be, they aren't beholden to the same things as you are in an S1. That said, yesterday we did see another company come public that, autonomous trucks with a subscription service that also had paltry revenues and is basically all on the come, Jim.
Well, Kathy Wood loves these.
Yes,
She's
bought a lot of that stock.
Yes, she did. If an EV leaf blows into her desk, she'll buy it. And I don't mean that as being any slight at all. That's something Larry Kudlow used to say. It would be like, and that person really doesn't know anything. With all due respect, that person is really terrible. But with respect. But yeah, she bought a lot of that one, and I said to
we're
myself,
talking about
wow,
too simple. I just want to make it clear, which we talked to the CEO yesterday.
It was too simple.
Yeah, it was too.
The whole thing was too simple. I wonder where she is with Jagdeep Singh. No, I'm not kidding. David, there is not a lot of due diligence being done. Now, no one would ever claim that they didn't do a lot of due diligence. Like when I was selling soda at Veteran Stadium in the 70s, I did a great deal of due diligence on Coca-Cola.
I'm sure you did.
Before I sold it.
Yeah, sure you did.
Check the label. Yeah. Hey, when I did ice cream, I didn't do enough due diligence. Hey, I got ice cream, vanilla and chocolate. I had not studied it enough, but boy, I was stupid. Carl, I'm all about.
I love hearing about all your old jobs, Jim. Let's take a break here. Market obviously having a little incremental gain over yesterday. About 25 points away now from 4,200. All right, Jim, what's coming up tonight?
Well, look, one of the things that happening in the back world is the attacks. And here I've got this outfit Scorpion that is just putting the wood to Jagdeep Singh, who is the executive who runs QuantumScape. So you know what? Jagdeep's firing back. He's coming on Mad Money. He's going to make his statement, say why Scorpion may not be right when Scorpion says that this is the next Theranos. You know, Carl, but you really don't, just in terms of the scheme of things, you don't really want to be called the next Theranos because it's about the most damning thing you can do. And I think Jagdeep deserves his day in court, and he's going to get it tonight on Mad Money.
Jim, we look forward to that. We got a few seconds left. I guess I'll just ask you about next week and the next couple of weeks as earnings continue to pour in. You know, one thing that's been said is that it's not like a few quarters ago where the analysts had no clue in the fog of war of COVID what the numbers were going to be. The fact that they're beating on pretty decent intelligence says something.
Yes, they were way too conservative, particularly on tech. And I've got to tell you, people are starting to realize, wow, things are much better than expected. And I think it's going to matter. I think we could still go even higher than we are. Wow.
Jim, good weekend. Look forward to seeing you tonight.
You
and, of course, back on set next week. Yep. We'll get Squawk on the Street continues.
No more dog. No more fire alarms. No more doorbells. No more wife yelling at me.
No more Chinese food.
Good Friday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan and David Faber. Opening brings us new highs once again on the Dow and the S&P, although we've settled back just a touch, obviously, as Morgan puts the closure to this first big week of earnings.
Yeah, we're going to talk about that a little bit more as I introduce you to not our Wheel of Fortune, but our Wall of Fortune. We're 30 minutes into the trading session. Here are the three big movers we are watching, starting with Morgan Stanley, posting blowout results in what has been a blowout week for the banks in general. But Morgan Stanley did have $911 million in Q1 losses tied to the Archegos fund meltdown. Shares are down slightly right now. We're also watching our parent company, Comcast. Raymond James upgrading the stock to outperform, telling its clients to expect strong results when Comcast reports on the 29th of April. And we continue to track, what else? Coinbase. Kathy Wood's ARK funds buying more shares of Coin, purchasing 110 million of that stock. You can see right now shares are up about 1.5%, trading around $327, $328 a share. Meantime, consumer sentiment is out right now, and Rick Santelli has that for us. Rick.
Yes, these are April preliminaries, so in a couple of weeks, we're going to get the final numbers and toss these. They're pretty strong. If we look at headline number, we're expecting 89, so the whisper number was larger than the 86.5 that just popped on the screen. But the interesting thing is in order to find a higher number than 86.5, should that be the final, you have to go pre-COVID. It was basically March of 20 when it was 89.1. So that is a good number, even though it's less than expected. Current conditions, 97.2, very powerful number versus 93, our final read last month. And if we look at expectations, 79.7. This is a big miss based on expecting a number more in the mid-80s, but it's exactly the same as our final look for last month, which was 79.7. Now, here's where it gets interesting. Our one-year inflation jumped to 3.7. Well, 3.6, last time we had that was 2012. So that number goes way back, and 2.7 on 5 to 10 year, well, we've already had 2.8, which was the highest since 2014. So that, in a way, moderated, but 2014, a while ago. So we want to pay close attention to these inflation data points, especially when we get the final read in a couple of weeks. Carl, back to you.
All right, Rick, thank you. That's interesting stuff. Rick Santelli. We've obviously been watching the bank earnings all week long. Goldman Sachs, JP Morgan Chase, Wells Fargo delivering what's been a pretty bullish economic guide. With more reaction to the earnings, let's bring in Pulitzer Prize-winning columnist for the New York Times, Jim Stewart. Normally joins us on Fridays. Jim, great to see you again. Good morning.
Good to see you, Carl.
It's
certainly been quite a week for the banks.
Yes, and I was going to ask you what part you found most interesting. I've thought about loan growth, Archegos on some, the capital markets, obviously, and some of the reserve releases. What do you think deserves to be the headline after this week?
Well, there's a lot going on there, but I guess what I was most impressed by and looking forward, I think, make these banks very attractive to investors is one of the most fundamental things, which is the yield curve. And that didn't seem to get as much attention. I mean, it's impressive that they've been able to release all these reserves, and that's given the earnings a big boost this week. But that's going to be kind of a one-time thing. The yield curve may be around for a long time, and I was kind of startled when I looked to see how steep it has become. I mean, the Fed has said that it's going to keep short-term rates near zero, and they are near zero. Meanwhile, the 10-year is moving up, the 30-year is moving up. We're hearing those recent inflation numbers. The economy is booming. Those long-term rates have already gone up. The 10 is at about, I think it's close to 1.7. So that spread between almost zero and the 10-year at 1.7 is quite high. I look at the historical data. It has been higher, but it's getting up there, close to maybe, 3/4 of the sort of peak spread in there. Well, that's very, very good for the banks because they pay deposits, at a low rate and they lend longer term at a high rate. And that differential is where they make most of their bread and butter money. And again, it's going to be more like the classic banks like JP Morgan and Wells Fargo, a little less the investment banks, but it's very bullish, both for the economy and for these bank earnings.
Right. And I assume you think that investors are going to give them more credit for that kind of growth rather than the trading activity, which historically investors have said, yeah, that's great, but what are you going to do for me next quarter?
Well, exactly. Although I don't see a lot of focus on this yet. I mean, again, I was looking at some of the multiples where these banks are trading, and, most of them are in what I would call the value category. They're trading at a below normal price earnings ratio, even with these new big earnings puffed up by the reserve releases. So, I personally, I think the banks look like very good values here.
A little bit and get your thoughts on the Coinbase debut we saw this week. I mean, largest direct listing to date, and certainly being heralded by some, particularly I think the cryptocurrency bulls, as a real success and a sort of coming of age moment for cryptocurrency more broadly. The flip side of this, though, is that retail investors were able to jump in with that listing this week, and we're still pretty well off the highs from where we saw this new stock begin trading.
Well, I think it's important to kind of separate some of this, generational enthusiasm for crypto for sound investment analysis. But that said, and so I'm not surprised it's come off a little bit of those, euphoric highs. And there's been a lot of static out there that, this is the coming age of crypto, and this is the way to play crypto, and, jump on the bandwagon, which really is, kind of passing enthusiasm in my view. But I do feel that Coinbase has a pretty impressive structural advantage here in the market, which is the classic network effect. And, tech investors love a network. I mean, Facebook is a great example of that. And you get a platform like this where it has the most users, so sellers want to be there and buyers want to be there. It's kind of like eBay in the early days, and they're charging quite a healthy transaction fee to trade, to take advantage of that. So I think the big question is they unquestionably do have a network effect, which could translate to some very impressive profits in coming years. It's going to be hard for others to overcome that. The question is how much competition is going to spring up. And in my own mind, I'm still kind of grappling with longer term. Is it going to be more like the credit card companies, which, again, classic network effects? Nobody has penetrated the dominance of really the big two, or even, you can add the American Express and Discover. There are only really 4 credit card companies. Is that going to be the situation with traders of the cryptocurrencies? Or is it going to become like stock trading where the commissions are like down to nothing? Everybody can do that.
Right.
So I think the key going forward is they're going to have to model themselves on the credit card companies. But I think they could do it.
It's interesting. Hey, Jim, have you owned Bitcoin along the way here? Do you own it now, or have you been sort of amongst those who kind of shake their head and say, yeah, why not?
I have not owned Bitcoin.
Why not?
I had friends who bought in, pretty early, kind of thought, it would just be a fun experiment. But no, I'm just an observer of this. I guess it's, but I get it. Particularly when you've got a super low interest rate environment like this, why not have a storehouse of liquid capital that could actually gain in value? It's a little bit like gold, I think, which has historically served that function. And I think I get it why a lot of people are looking at it as a legitimate asset class.
I'm curious what you think about the SEC that's taking shape. We've got Gensler taking the helm officially this week. A lot of focus on what that's going to mean for cryptocurrencies, the possibility of something like a Bitcoin ETF. But there's a lot of stuff on the SEC's plate in general right now as this new team basically now materializes and, as I said, take shape. Also SPACs.
Yeah, well, there's a lot for them to look at. Gensler, I think, is a impressive choice. He's got great credentials, and they are going to have their plates full. On the other hand, this isn't really any different, these markets, than many others that have sprung up. And the question, I think, is simply going to be how much regulation and how much disclosure. I mean, we've seen already some pretty big scandals and frauds in the cryptocurrency area. But the SEC has the tools, and we have the laws. I mean, one of the things I've always thought is so great about the securities laws in the United States, although they're sometimes criticized for this, is how vague they are, and that enables them to be very flexible to cope with new trading patterns and new asset classes. And so I don't think there's anything to stop them. And I hope they will, in fact, focus on some of these new areas. Because as we know, with everything happening in SPACs, something bad is going to happen one of these days.
Yes, that's generally the view. Question is when and what. Jim, I guess we'll have to wait and see. Great seeing you. Thanks for the help on the
Nice to
financials
see you.
today. Talk soon. Jim Stewart.
Great. Have a good weekend.
You too. Well, we got some retail names on the move. Courtney Reagan has that for us. Hey, Court.
Hi there, Morgan. So as the economy rebounds, retailers, of course, are poised to catch on to consumer spending. They want those dollars. And over the last year, the S&P retail ETF is up 180%, hitting a new high again here today. Remember, yesterday, JP Morgan Chase CEO Jamie Dimon said on a call with reporters that consumers are coiled, ready to go. They're starting to spend money. But even when you take a look at the laggards, they're still up between, say, 16 and 20% over the last year. Names like Dollar General, Kroger, CVS, Walgreens. Of course, those are staples names, but names that were played early on in the pandemic trade as beneficiaries of the pandemic, essential retailers that were allowed to keep their doors open during those early, pretty scary days, frankly. And Amazon, we talk about it all the time. It's the company that changed retail and other industries forever. It's actually within the top 15 laggards for retailers over the last 12 months, but it's still up 40% in a year. And then take a look at some of these PE ratios. Kroger's forward 12-month PE about 13 times, looking relatively cheap when you look at the overall market. Maybe it's time to revisit some of these early pandemic plays as time to go in again, as opposed to some of the other names that seem more obvious when we're talking about the denim trade so much, with like a Levi or an American Eagle, for example.
Mom jeans. I'm not for it. I realize that's the fashion now, but I'm just holding off on it. I'm already a suburban soccer mom. I don't need the mom jeans.
I am too.
All right, Courtney Reagan. Thank you.
I don't think those are flattering.
As we head to a quick break, here's a look at our roadmap for the rest of the hour, including an exclusive with new Fed Governor Christopher Waller in his first televised interview.
Plus, investor David Einhorn is blaming Chamath Palihapitiya and Elon Musk for throwing, quote, jet fuel on the GameStop retail trading frenzy.
And the reopening headwinds for restaurants. We'll discuss with the CEO of Red Lobster on a hiring spree, but having some trouble finding workers. Big show still ahead on Squawk on the Street.
Greenlight's David Einhorn blaming Chamath Palihapitiya and Elon Musk for throwing, quote, jet fuel on the GameStop frenzy in January, adding, quote, if regulators wanted Elon Musk to stop manipulating stocks, they should have done so with more than a light slap on the wrist when they accused him of manipulating Tesla's shares in 2018. Interesting letter from Mr. Einhorn, Carl. Always worth at least listening to some of his thoughts. Although I would point out, of course, when it comes to Tesla and Mr. Musk, he was short the stock, I think, famously for some period of time. And if you've been shorted for some period of time, chances are you did not do particularly well.
Yeah, I was also looking back, David, to his Q3 letter last Halloween, where he said we're in an enormous tech bubble, questioned the market's sanity, said all the signs of a bubble are there, including IPO mania, which certainly has not, at least in his view, I'm sure, has not come back in any way.
No, not at all. And, you know, we won't go into his long-term track record. But again, he is a thoughtful fellow. Yeah, I mean, your point is a good one when it comes to that and a lot of other things as well, Morgan, in terms of, you know, I guess what I would say is we all wondered about the behavior of Chamath and Elon, sort of fanning the fuel there on Twitter and and on television in terms of that cohort that decided that GameStop was a company worth $20 billion.
Yeah, and whether right or wrong, I would say, you know, this again elicits the debate around that, and sort of, I think also, again, whether right or wrong, kind of, what's the word I'm looking for? It kind of, this idea of a tiered system, a non-democratization of the markets that kind of fueled the populist, I think, sentiment behind everything we've seen over the last couple of months. In some ways, these comments, I think, kind of reinforce that reality. The irony here is that whether you're Chamath Palihapitiya, Elon Musk, or David Einhorn, you're all basically saying, don't focus on the day traders, focus on a system that's arguably broken and how it's being regulated. And I think that's probably going to be the longer-term debate that plays out now, including given the fact that we have a new SEC in place, if you will, with Gensler taking the helm. Meantime, let's get over to our Steve Leisman alongside newly minted Fed Governor Christopher Waller. Steve.
Yes, Morgan, thanks. We have Chris Waller, the new Fed governor, joining us for the first time for his first television interview. Governor Waller, thanks for joining us.
Hey, Steve. Thanks for having me on.
Yeah, and maybe if people hear a certain familiarity in your voice, people should know that I've known you as the research director of the St. Louis Fed before you became a big deal here at the Fed for a number of years. So worth pointing that out. Governor Waller, let's start, I think, having this opportunity to hear your views for the first time. Let's start at the very beginning. What's your view of where we are in this recovery from the pandemic and where the U.S. economy is going?
Well, Steve, I think the economy is ready to rip. We're looking at growth forecast of nearly 8% for Q2. My forecast is about 6.5% for the year. I see unemployment falling to the low fives by the end of the year, and inflation running about 2.5% for the year. So I think the economy is really ready to go. The vaccine program has done amazingly well. There's still more to do on that, but I think everybody's getting a lot more comfortable with having the virus under control, and we're starting to see it in the form of economic activity.
When you look at the character of the economic activity right now, do you see us going through a sugar high right now that is essentially based upon the huge amount of fiscal stimulus coming through, or are we on the verge of what you would call sustained growth?
Yeah, no, I think it's more on the sustained growth. You're going to see some, surge in demand from the stimulus. You're going to see it from the pent-up savings, just the desire to get out of your house and go do things that you haven't been able to do for a year. So you're going to see that, a bigger surge. But I think the fundamentals of the economy are, we can get the virus pretty much under control. We get, 70% of the population vaccinated. Then all the fundamentals are there for good, strong growth that we left back in January, February of 2020 last year.
So getting back to the familiarity here, Chris, you and I have both been following Fed policy for a very long time. And you have to admit, given that outlook you just gave, it would be normal for a Federal Reserve official such as yourself to be talking about constraining what is easily the most wide open policy that you and I can ever remember. Is that what you're thinking? Is it time to put the brakes on here, given that you just said, I think we have up there on the screen, that the economy's about to rip?
Yeah, I mean, the thing is we have to keep in mind that from the level of where we were, we're not there yet. So we've still got room to catch up where we were. We're making up for lost ground. So just because the growth rates are really good and everything's looking like we're heading off in the right direction, we're still trying to make up a lot of ground. As you know, Chair Powell has said, we're still down somewhere in the neighborhood of 8 million jobs from where we were just a little over a year ago. So we've got to make that up first. Other parts of the economy seem to have already come back, but we still have relatively high unemployment rates, particularly for minorities. And so we've still got a long way to go. There's no reason to be pulling the plug on our support until we're really through this.
One of the potential downside here that we hear it has a lot of getting a lot of concern out there is the issue of inflation. And let me just give you some of the data from this morning, Governor Wall, that I bet you've seen. The University of Michigan one-year expectation for inflation at 3.7%, the highest since 2015. The 5-year at 2.7 is just one tick off the high since 2015. Are you a subscriber to this idea that inflation that may be coming will be temporary? And how can you be so sure?
Yeah, I am. I do buy into the idea that this is going to be temporary. We know there's a bunch of reasons for this. One is just the base effects. We're coming off very low readings. Everybody forgets that service prices dropped something like 6%. So they can come up 6% and you're just back to where you were last March. So you can't, again, you just can't look at the growth rate. You got to look at the levels where you're at. We know this stimulus is going to have some impact, but once the stimulus checks are spent, they're gone. Once the pent-up savings is spent, it's gone. There's no further demand, excess demand coming out of those things. We also know the bottlenecks that are currently there are going to go away. Firms are going to get capacity up and running again. So whatever temporary surge in inflation we see right now is not going to last. And I think if you look at the, as you said, 5 years, they're still around the 2.5%. They haven't really taken off. They're about where we would think is reasonable, and these are people that have money on the line, so they're not betting on outrageous runaway inflation. We'd see it in their pricing of tips.
If Fed policy right now is to let inflation run above its 2% target, how comfortable will you be with inflation running? For how long and at what level above target before you begin to have some concern?
Yeah, I mean, the committee's been very clear. We're happy to let it rise above 2% right there. We were below 2% for 7 years, and we kind of let that go, but just temporary bumps back up to 2. So that's kind of the idea. We want it to be on average around 2%. I don't think anybody would be very comfortable if it got to 3 or 3 plus and stayed there for a while. The bigger concern is if it did and we saw inflation expectations drifting up to those levels, then we've got a problem we got to worry about. So as long as inflation expectations are anchored near our 2% target for PCE, although a lot of these things are in CPI numbers, I think we're okay. We're not going to be worried about inflation being. Now, again, we're not going to just let it rip either. Inflation's not going to just take off. We're going to sit here and say, oh, that's fine.
Governor Waller, right now, when I look at the Fed futures, obviously there's a lot of noise in all that outlook there, but they're pricing in a rate hike at the end of 2022. Is that appropriately priced in your mind? And what role do the Fed dot plots or the forecast for the inflation, for the funds rate, what role does that play in market expectations? Is it helping or hurting?
Yeah, I think the dot plot is kind of a problem right now. As you know, we adopted the new framework last year, which is an outcome-based framework. And the SEP was designed for our own old framework.